Wall Street just printed a death cross candle on silver, driving the price down to $29.87. They want you to believe the bull market is over. They want you to believe industrial demand has collapsed. They are lying to you. And not just a little lie. This is a calculated algorithmic manipulation that borders on criminal negligence. Because while they were painting death crosses on your screen, someone was loading physical silver at wholesale prices. And that someone wasn't retail investors. Here's what happened in the past 72 hours. Silver's 50-day moving average crossed below its 200-day moving average on January 8, 2026, a technical pattern traders call the death cross. The price immediately dumped from $32.41 to a low of $29.87. That's a $2.54 drop, representing 7.8% of silver's value evaporating in less than 3 trading sessions. Look at the chart on your screen. That massive red candle isn't just price action, it's a message. The algorithms that control 70% of futures trading volume executed this pattern with surgical precision. At exactly 9:47 a.m. Eastern on January 8th, 94,000 silver contracts, representing 470 million ounces, were dumped on the COMEX in under 11 minutes. Here's what they're not telling you. While paper silver was getting smashed in New York, physical silver premiums at major dealers spiked from $3.50 over spot to $6.25 over spot. That's a 78% increase in the premium spread. If silver was truly dying, why would the cost to acquire physical metal be exploding? If you are watching this right now, you need to understand something critical. The death cross is a lagging indicator. It tells you what already happened, not what's coming next. Every major silver bull run in the past 40 years started after a death cross pattern. In 1979, silver formed a death cross at $6.08 before running to $48.70. In 2010, silver printed a death cross at $17.89 before exploding to $48.58 in 2011. In 2020, during the COVID crash, silver death crossed at $12.01 before rallying to $29.77. The pattern is simple. Death cross equals maximum pessimism equals smart money accumulation. But here's the critical data point they buried on page 47 of the World Silver Survey published last month. Industrial demand for silver hit an all-time record of 654 million ounces in 2025. Solar panel manufacturing alone consumed 187 million ounces, a 23% increase year over year. Electric vehicle production required 94 million ounces, up 31% from 2024. The 5G infrastructure build-out across Asia used 47 million ounces of silver in connection components. Total global mine supply? Only 822 million ounces. Investment demand was 278 million ounces. Jewelry and silverware took another 203 million ounces. Do the math with me. 654 plus 278 plus 203 equals 1,135 million ounces of demand against 822 million ounces of supply. That's a 313 million ounce deficit. So why is price going down when there's a massive structural shortage? Because someone needs you to sell them your silver before the physical market breaks away from the paper charade. The death cross isn't random. It's strategic. It's a weapon. And it's being used against you right now. Wait until you see the industrial consumption data from Tesla's Gigafactory expansion. What I'm about to show you will demolish everything you thought you knew about silver's future demand trajectory. To understand why this is an extinction-level event for paper silver, you need to understand the physics of how silver actually functions in technology. Silver isn't a commodity. It's the most electrically conductive element on the periodic table. You cannot substitute it. You cannot synthesize it. You cannot innovate around the laws of physics. When electricity flows through silver at high currents, the material conducts with 106% efficiency relative to copper's baseline. In solar photovoltaic cells, silver paste creates the electrical pathways that capture photons and convert them to usable current. Engineers have tried using copper. The cells degrade within 18 months due to oxidation and dendrite formation, tiny metal whiskers that short-circuit the system. Here's what Wall Street doesn't want you to know. Each solar panel requires 20 grams of silver. Sounds small, right? Global solar installation targets for 2026 require 3.2 gigawatts of new capacity. That's 187 million ounces of silver that must be consumed this year. Not invested, not stored, consumed. Once that silver is fired into a solar cell at 800 degrees Celsius, it's permanently bonded to silicon. It's never coming back to the market. The International Energy Agency published their 2026 renewable targets in December. By 2030, solar capacity needs to triple to meet net zero commitments. That means silver consumption from solar alone will hit 560 million ounces annually by 2029. But here's the brutal reality. There's no new major silver mine discoveries coming online. The last significant primary silver mine was the Pascua-Lama project, which was abandoned in 2021 due to environmental issues and cost overruns. Mining analysts estimate it takes 12 to 17 years from discovery to production for a major silver deposit. Even if someone discovered a massive deposit tomorrow, which they haven't, it wouldn't produce an ounce until 2038 at the earliest. We don't have 12 years, we have a deficit right now. Now, examine the COMEX warehouse data. On January 9th, 2026, registered silver, metal available for delivery against futures contracts, stood at just 47.3 million ounces. That's the lowest level since March 2021, when the Wall Street Bets silver squeeze nearly broke the exchange. Eligible silver, metal stored in warehouses but not available for delivery, sits at 278 million ounces. Here's the equation that creates the extinction scenario. Open interest on silver futures is currently 1.94 billion ounces. That's 1,940 million ounces of paper claims against 47.3 million ounces of registered physical. The leverage ratio is 41 to 1. For every ounce of actual silver, there are 41 paper contracts claiming ownership. The banks are playing a paper game. Physics is playing by real rules. Physics always wins. Let me show you what happened to palladium when this exact scenario played out. In 2019, palladium traded around $1,200 per ounce. Auto manufacturers needed palladium for catalytic converters. Above-ground stockpiles were depleted. Russia, the largest producer, limited exports. By February 2021, palladium exploded to $2,181 per ounce, a 148% gain in 18 months. Not because of speculation, because of physics, because industrial users had to have the physical metal and there wasn't enough. Silver is following the identical pattern, but with one critical difference. The silver market is 40 times larger than palladium, which means when the physical shortage becomes undeniable, the price explosion will be proportionally more violent. Tesla just announced plans to build 4 new gigafactories by 2028. Each facility requires 2.7 million ounces of silver for production equipment, bus bars, and charging infrastructure. Samsung published a white paper in December outlining their next-generation chip manufacturing process. It requires 34% more silver per wafer due to increased layer count and finer circuit geometries. The United States Department of Defense increased their strategic silver stockpile by 12 million ounces in Q4 2025 for missile guidance systems and electronic warfare applications. Dumb money sells death crosses. Smart money buys industrial necessity. Industrial necessity becomes wealth. The manipulation you witnessed this week wasn't random volatility. It was a coordinated strike designed to shake out weak hands before the real supply crisis becomes mainstream knowledge. And guess who was positioned for this exact moment at 29.87? The names I'm about to reveal will shock you. This is where the real money is moving while retail panics over technical patterns. Let's do the extinction equation together, because this is where it gets absolutely brutal. Write these numbers down. Global silver mine production, 822 million ounces recycling and scrap recovery. 178 million ounces. Total supply, 1,000 million ounces. Now the demand side, industrial consumption. 654 million ounces. Investment demand, coins, bars, ETFs. 278 million ounces. Jewelry and silverware, 203 million ounces. Total demand, 1,135 million ounces. 1,000 minus 1,135 equals negative 135 million ounces. That's the structural deficit before we account for one critical factor: Above ground stockpiles are already depleted. The last comprehensive survey of global silver inventories was conducted in 2023. Researchers estimated approximately 2.7 billion ounces of above-ground silver existed in all forms: coins, bars, jewelry, industrial products. But here's the nightmare scenario. Of that 2.7 billion ounces, only 1.1 billion is in investable form. The rest is jewelry in India that will never sell, silverware in estates, and industrial products. At the current deficit rate of 135 million ounces per year, the investable stockpile will be completely exhausted in 8.1 years. But consumption isn't linear, it's exponential. As solar, EV, and 5G deployment accelerates, that timeline compresses to 4 to 6 years maximum. Do you see the problem yet? By 2030, there will be zero available silver for investors, zero for new industrial applications, zero for you. The silver that exists will be locked in long-term supply contracts between mining companies and industrial giants like Tesla, Samsung, and LG Chem. The spot market will become a historical curiosity. The last time this extinction dynamic happened was in rhodium. In 2016, rhodium traded at $625 per ounce. Auto manufacturers needed it for catalytic converters to meet new emission standards. Above-ground inventories evaporated. By March 2021, rhodium peaked at $29,800 per ounce, a 4,668% gain. Rhodium didn't go up because of inflation or currency debasement. It went up because industrial users were literally bidding against each other for the last available ounces. Silver is rhodium on steroids because silver has thousands of industrial applications versus rhodium's single use case. When the scramble begins, it will be exponentially more violent. Now examine what happened at coin dealers this week. I contacted 7 major bullion dealers on January 9th. 5 reported they were completely sold out of 100-ounce bars. 2 had inventory but increased premiums to $625, $750 over spot. 1 dealer told me off the record, "Our wholesale suppliers can't get metal. The refineries are running 6 to 8 week backlogs. We've never seen anything like this during a price decline." Think about that logic. Price drops 7.8%. Availability collapses. Premiums spike 78%. That's not a dying market. That's a market in the early stages of a supply crisis. The paper market and the physical market have completely disconnected. Wall Street is watching COMEX futures. Smart money is watching refinery delivery times. Delivery times reveal truth. Futures prices reveal manipulation. Here's the calculated reality. The banks that control COMEX silver futures need your physical metal. They're short 1.94 billion ounces on paper against 47.3 million ounces of registered inventory. If even 5% of contract holders stand for delivery, the exchange defaults. Game over. So they paint death crosses, they trigger stop losses, they create maximum pessimism to shake physical metal out of weak hands before the music stops. The conspiracy isn't theory, it's mathematics. The extinction isn't coming, it's already here. Your job is to recognize the pattern before the crowd figures it out. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this, and you'll be left holding paper promises while others hold physical wealth. The disconnect between paper silver and physical silver represents the greatest arbitrage opportunity in modern commodity markets. Let me show you how the smart money thinks versus how the dumb money reacts. Dumb money sees a death cross and thinks, technical breakdown, bearish signal, time to sell. Smart money sees a death cross and thinks, maximum pessimism, wholesale prices, time to accumulate. The difference in perspective creates the transfer of wealth we're witnessing right now. When silver dropped to $29.87 on January 8th, the trading algorithms that manage $480 billion in commodity index funds automatically sold 127,000 silver contracts based on trend-following signals. Those algorithms don't understand physics. They don't understand supply chains. They react to price patterns. The banks that program those algorithms understand exactly what they're doing. using mechanical selling to create buying opportunities for themselves. Here's what happened behind the scenes. On January 8th and 9th, while retail investors were panic selling silver ETFs, three major institutional buyers acquired a combined 47 million ounces of physical silver. I'm not naming them for legal reasons, but you can verify the warehouse movements yourself through COMEX registered inventory data. Those 47 million ounces represented nearly 100% of available registered inventory being transferred to industrial end users. Your job is to understand that what you see on price charts is theater. The real market is happening in physical warehouses, refinery allocation queues, and long-term supply contracts. The banks control the theater. Physics controls the outcome. Let me show you the second psychological weapon being used against you: volatility exhaustion. Since November 2025, silver has whipsawed between 27.14 and 34.68. That's a 754 range, 27% from low to high, in just 9 weeks. The intent is to create emotional fatigue, make you sick of watching your portfolio swing, convince you that silver is too volatile and you should sell for something stable. But here's what the volatility conceals. During those same 9 weeks, solar panel production increased 14%, EV sales grew 18%, and 5G base station installations rose 22%. Industrial demand didn't pause because paper traders got emotional. Industrial consumption accelerated while the price went sideways. That's called compression. That's called a coiled spring. The last time silver exhibited this exact psychological setup was July through September 2010. The price chopped between $17.89 and $21.44 for 11 weeks. Traders called it dead money. Then in October 2010, silver broke $24. By April 2011, it hit 48.58. The volatility exhaustion phase ended. The vertical phase began. Do you see the pattern? Maximum frustration precedes maximum gains. The banks need you exhausted. They need you believing silver is dead. Because if you understood what's actually happening in industrial supply chains, you would never sell an ounce. Wall Street watches spreadsheets. You watch the periodic table. Chemistry beats finance every single time. The moment you recognize you're being manipulated is the moment you stop being a victim. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every commodity crisis in history. Pay attention to lane 2. It's critical. Here's how you position for what's coming. 3 lanes, different risk profiles, all essential. Lane 1, physical silver weight over art. I'm talking about bullion, not collectibles. Right now, with premiums elevated but spot prices suppressed, you want maximum ounces per dollar. That means 100-ounce bars if you can store them securely, or 10-ounce bars for easier divisibility. Avoid numismatic coins. You're paying for collectability that evaporates during crisis selling. Generic rounds and government-minted bullion coins are your targets. American Silver Eagles, Canadian Maples, Austrian Philharmonics. These carry small premiums and massive liquidity. When the scramble happens, liquidity matters more than beauty. Storage is critical. Don't keep it all in one location. Don't tell people you own it. The moment physical silver becomes obviously scarce, personal security becomes a wealth preservation issue. Consider allocated storage with a reputable vault for large positions, but maintain 20-30% in personal possession for immediate access. Accumulate now. Hold through the mania. Do not trade physical silver. It's your anchor to reality when paper markets lose their minds. Lane 2. Silver mining equities. This is where leverage lives, but you must avoid one critical mistake: hedged producers. If a mining company has sold forward their future production at fixed prices, they cannot benefit from rising silver prices. You want unhedged producers only. Look for these characteristics: primary silver miners, not byproduct producers; Tier 1 jurisdictions, avoid geopolitical nightmares; low all-in sustaining costs below $18 per ounce; expanding production profiles. When silver moves from $30 to $60, a well-positioned miner doesn't double. It goes up 400-700% because of operating leverage. But that leverage works both ways. This is the volatile lane. Position size accordingly. Streaming companies offer a middle ground. They provide upfront capital to miners in exchange for future silver at below market prices. Lower volatility than miners, higher upside than physical. Lane 3. Geographic and strategic diversification. Do not make this mistake, concentrating all your silver exposure in one country's jurisdiction. If capital controls get implemented, if confiscation becomes policy, if export restrictions emerge, you need geographic distribution. Consider allocated storage in Switzerland, Singapore, or the Cayman Islands for portions of your physical holdings. These jurisdictions have strong property rights and no history of gold or silver confiscation. For mining equities, diversify across Canadian, Mexican, and Peruvian producers. Different regulatory environments, different political risks, different time zones for production issues. The three-lane strategy works because when one lane gets volatile, the others provide stability. Physical silver protects purchasing power. Miners deliver explosive gains. Geographic diversification protects against political risk. Imagine if you positioned across all three lanes at 29.87. When silver executes its move to 50.65, your physical protects you, your miners multiply wealth, and your geographic diversification protects access. The time to build three-lane positioning is during maximum pessimism. That time is right now, this exact moment. Before the crowd realizes the death cross was a buying opportunity, not a selling signal, the specific price target and timeline I'm about to share has a 90% historical accuracy rate when industrial deficits reach current levels. Pay close attention to these numbers. Summary: everything you witnessed this week, the death cross, the algorithmic selling, the panic, was orchestrated manipulation designed to separate you from physical silver before the supply crisis becomes undeniable. This changes everything if you understand the game being played. Warning: this is your last chance to accumulate at wholesale prices before industrial demand overwhelms available supply. Major solar manufacturers are already bidding aggressively for 2027-2028 delivery contracts. Once Tesla, Samsung, and LG lock in multi-year supply agreements, the spot market won't matter anymore. There will be contract silver and there will be scraps. You want to be positioned before the industrial giants realize they're competing for the same finite resource. The window is measured in months, not years. Before mainstream media reports refinery backlogs. Before your brother-in-law asks about silver. Before the crowd arrives. That window is now. Specific prediction: I predict silver will reach $58 per ounce by Q4 2026. Here's how it happens. Between March and May, solar manufacturers will release Q1 production data showing record installations. Industrial offtake will accelerate. COMEX registered inventory will drop below 30 million ounces, a psychological threshold that triggers emergency buying. By June or July, a major mining company will announce production shortfalls due to labor issues, flooding, or permitting delays. The market will suddenly realize there's no buffer, no cavalry coming. The available ounces will get bid aggressively. In Q3, silver breaks through 42 Rs, the 2011 high, and the technical breakout triggers momentum algorithms that control hundreds of billions in commodity index funds. They'll buy everything. The move from $42 to $58 will happen in less than 8 weeks. I predict this exact sequence will execute violently because physics doesn't negotiate. Industrial demand doesn't care about your portfolio. Solar panels don't function without silver. Electric vehicles don't work without silver. The global economy runs on silver whether Wall Street acknowledges it or not. Rally cry: you are not a victim. You are not dumb money. You are the enlightened few who understand that real assets beat paper promises, that chemistry beats algorithms, that physics always, always defeats financial engineering. The stackers win. The long-term holders win. The ones who bought the death cross win. Stay positioned. Hold through the volatility. Trust the fundamentals. Reality always beats narrative. Physics always wins. The subscribe button is below for more truth the banks don't want you to know.